Hi, this is James Shrug with Westpac London's end of day report for Monday, October the 24th. The session today actually started with a reasonably positive tone because of the better than expected advanced release of the latest PMI for the factory sector in China, which showed a bit of a recovery after 3 weaker readings. That provided a bit of a boost to sentiment, certainly a strong one in Asian markets, and helped markets along in Europe as well. However, the focus has since moved on to other matters. We had the equivalent PMI survey for Europe released. It showed a further decline. In fact, the composite PMI, which includes both manufacturing and the services sector, fell to 47. That's below the 50 level, which indicates the cut-off between positive and negative for the second month running. It actually mirrors, the profile of that index mirrors what it did back in 2008. When the European economy was entering recession. So that's yet another indicator pointing to a pretty dire or weak economic outlook ahead for Europe. We also saw industrial orders figures for the month of August released. Annual growth in orders was running at 20% compared to a year earlier. In the first quarter of this year, it's now running at just 6% growth. And when you look at indicators like industrial production and retail, when you look at indicators like industrial production, it's still got some momentum because of that previous orders strength. But with orders now softening, that's another indicator that the factory sector in Europe is going to be slowing rather than maintaining its recent pace. So the news on the European economy hasn't been particularly crash hot. We've seen or heard a few announcements from EU leaders who of course won't deliver their full package of measures until Wednesday. What we do know is that Germany got its way in terms of the leveraging up of the European Financial Stability Facility. It won't be treated like a bank. It won't be able to access the funds from the European Central Bank. We also know that the haircut that that lenders to Greece are going to have to voluntarily agree to, it could be as much as 50 or 60% compared to the 21% haircut that was agreed just as recently as July. They still want this to be a voluntary restructure and not a forced restructure, which would trigger credit default swap contracts, which is something the ECB is adamant must not happen. Our view is that ultimately will be a restructure, but certainly it's not something that we think will be announced as soon as this Wednesday. So look, given that we've seen so much speculation about what's going to happen, what won't happen, many leaks and contradictory comments from unsourced officials over the last week, markets seem to have grown a little bit tired of all this, and they haven't actually responded with too much aggression to the announcements that have been coming through. In the US, Caterpillar had a good result, beat analysts' expectations, but we've seen over the weekend Fed officials, including Janet Yellen, the Deputy Chair of the Federal Reserve, suggesting that a further round of quantitative easing, QE3, could be possible in the US, could prove to be necessary. We saw another Fed Governor, Dan Tarullo, say that the Fed might need to restart its purchases of housing mortgage-backed securities to help provide a bit of support to the housing market, which, as we've been talking about for many weeks and months now, is still going backwards 2 years and plus into the economic recovery. We had the New York Fed President, Bill Dudley. He didn't go quite as far as his colleagues, but he certainly said that housing was one of the key priorities of the Federal Reserve, and he wanted to avoid the economy needs to avoid the vicious cycle of house prices falling, leading to more defaults and foreclosures, leading to more issues in the banking sector, leading to a drying up of credit, and so on, a downward spiral. So there's been, and also PIMCO, that's right, one of the biggest bond investors in the world. They're saying that they think the Fed will indeed embark on a further round of quantitative easing. So QE3 talk has certainly been a big driver of markets today, and I'll run through the numbers in a minute. In fact, they're probably the main points to make, I think. The big beneficiaries of all this QE3 talk have been commodity markets, with copper prices today up 5%. I think the stronger Chinese data also has helped commodity prices along, of course. We've got oil prices up 1.8%, $88.99 a barrel. Gold prices are up 1.2% today, looking at $1,656 an ounce. And sugar prices, just to throw them in, they're up 1.5% as well. On equity markets, it's been pretty choppy today. We're not looking at particularly stellar gains. It's just after 3:30 in London at the moment, so we've got another hour and a half of European trading to go, and of course the US is still trading for some hours beyond that. But at the moment, we've got the Dow in the US up 0.6%. It's at 11,881. And in Europe, we've got the London market up 0.75%, the French market's up 0.6%, and the German market's up 0.6% as well. Within those markets, there's certainly some jostling position, with commodity firms doing better, with some banks doing worse, and so on. But I think that the next big test, or next big driver of markets, clearly is going to be what happens on Wednesday. Given all that, the only other thing I've got to mention is the Aussie dollar, which is at 1.044 against the US dollar at the moment. It's also been a beneficiary of this increased talk about quantitative easing from the US. The stronger Chinese PMI also helped the Aussie dollar along as well. We've got Deputy Governor Rick Battolino giving a speech tomorrow, or today, your time in Sydney. And for our New Zealand viewers, we've got inflation figures coming up today. We've got the pre-election government budget figures to be released, and the new employment indicators coming out as well. So 3 things to watch for in New Zealand today as well. Okay, I'll be back same time tomorrow.